Have you ever stared at a blank chart and just felt completely lost? Yeah, we've all been there. It's like an empty canvas with no instructions. But what if you had a clear, powerful blueprint to follow every single day? Well, let's build that framework right now and turn that blank chart into a map of high-probability trades. See this? This is where we're headed. This isn't just a bunch of random candlesticks anymore. This chart is telling a story. It's showing you, plain as day, exactly where the market cares about doing business. And in this explainer, we're going to build this together, step by step, so you can understand exactly what your chart is trying to tell you. All right, so our first tool in the toolbox is the volume profile. And I absolutely love this analogy. Think of it as an X-ray for the market. You know those regular volume bars at the bottom of your chart? They tell you when people were trading. But the volume profile, it tells you where they were trading. It shows you the hidden skeleton underneath all the price action. So to get a little more specific, the volume profile basically takes that volume information and flips it on its side. Instead of tracking volume per minute or per hour, it tracks it per price. And let me tell you, that is a total game changer because you can instantly see the price levels that the big players and the market as a whole truly care about. Okay, now the absolute king of the profile is the VPOC. That stands for Volume Point of Control. It's the one single price where the most buying and selling happened. You really want to think of it like a powerful magnet for price. It's the market's center of gravity, the spot everyone agreed was the fairest price. We are going to be watching this level like a hawk. Next up, we've got HVNs, or high-volume nodes. Now, these aren't just single lines, they're wider zones where you see a big bulge in the profile. An HVN tells you that the market spent a ton of time there, which means it's an area of agreement, of balance. It's a comfy spot for the price. So it tends to get kind of stuck there and just chop around. And on the flip side, of course, you have LVNs, the low-volume nodes. These are the really skinny, thin parts of the profile. This is where the market basically said, nope, don't like this price, and moved through super quickly. For us traders, these things are like vacuums. Price doesn't stick around, it just shoots right through them. And this little sketch just shows how it all fits together perfectly. You can see the VPOC is that one biggest bar, that's the peak. The HVNs are the other big, chunky areas of volume, and those valleys in between, those are your LVNs. So price consolidates in the fat parts and moves fast through the skinny parts. Simple, right? But incredibly powerful stuff.
Now, you might be thinking, okay, this volume profile thing is awesome. That's all I need. But, trying to use it all by itself can be really, really tough. It tells you where all the action happened, but it doesn't give you the full context of how it all went down. And that's exactly why we need to bring in a partner tool.
And hey, don't just take my word for it. This is a direct quote from the source material we're using. It's a critical piece of advice, so let it sink in. The real edge comes from combining the volume profile with the market profile. Let's dig into why that is. Let's think of it this way. The volume profile is the what. It's like a magnifying glass showing you the raw data, where the volume traded. But the market profile, that's the why. It's the storybook. It adds the narrative showing you how the price was accepted or rejected over time, revealing patterns that volume by itself just can't see. Specifically, we're going to borrow a few key pieces of intel from the market profile. We're going to grab its own point of control, which is based on time, not volume. And we're also going to look for two really important clues called a poor high and a poor low. These basically signal that there's some unfinished business at the edges of the market. All right, this is it. This is where we put it all together into a practical daily routine. This is how you build your map for the day before the market even opens for business. And the real key here is that we're going to look at yesterday's action to prepare for today. And it all boils down to this super simple four-step checklist. Every single morning, before you do anything else, you look at the previous day's chart and you mark these four things: the volume point of control, the high and low volume nodes, and the market profiles point of control. That's it. Your prep work is done.
And what's so crucial to understand is that these levels you just marked, they aren't just random lines on a screen. They are your roadmap for the day. They represent the most significant battlegrounds from the day before. You got to remember, the market has a memory, and these are the places it's most likely to react to.
So, we've got our map. Now what? Well, a map is pretty useless if you don't know how to read it, right? So this section is all about the game plan. It's about execution, how to actually trade off of these levels we've just drawn.
And honestly, the core idea here could not be simpler. We are not trying to be fortune tellers. We are not predicting where the price will go. All we're doing is waiting for the price to come to one of our key levels, like the VPOC or an HVN, and then we trade the reaction. The market will either smash right through it or bounce off of it, and that's our signal.
This table pretty much lays out the entire game plan. It's super straightforward. If price breaks out of a big, high-volume area, where's our target? The next low-volume area, or a poor high or low, that vacuum we talked about. And what if price gets rejected? Same target. We're simply trading from one important zone to the next.
Okay, before we move on, I have to stop and say this is, without a doubt, the most important rule of them all. This is a non-negotiable. No strategy on earth is right 100% of the time. You must know your risk and have your stop loss in place before you even think about clicking that buy or sell button. Protect your capital, always.
Okay, we're almost there. There's just one final, absolutely critical rule that makes this whole system work over the long run. It's all about keeping your chart clean, relevant, and focused only on what matters right now.
And here it is, the golden rule. As soon as one of your levels has been clearly tested, meaning the price came to it and had a significant reaction, you delete it. Get it off your chart. It's done. It has served its purpose.
Now, you're probably asking, why would I do that? Why not just leave it there? Well, the reason this is so important is because it forces you to make a distinction between what was important and what is important going forward.
And this slide just says it all, doesn't it? A tested level? That's history. It's old news. The market has already processed that information. But an untested level, that is pure opportunity. That holds future potential because we haven't seen the market's reaction to it yet. By deleting the old levels, you keep your eyes focused squarely on the fresh, high-probability opportunities.
So, we've come full circle. We started with a blank chart, and now we have a complete blueprint for reading the market's real intentions. So the final question I want to leave you with is this. Now that you have the blueprint, take a look at your own chart. Is it really telling you the whole story?
If you found this helpful, please like and subscribe. And make sure to click the playlist up here to catch up on any concepts you might have missed.